If you want to buy shares, you should not try the impossible, to look for the best time. If you have found a company that you are convinced of and you can buy it at a good price, then you should definitely go for it. If one has decided to buy, it means from now on to hold the share, even if the price should fall, because it may take some time until other investors have recognized the value of the share and also buy, otherwise the price does not rise, because the share price is based on supply and demand. When other investors recognize the true value of the company and get in, you cannot predict or influence. Sometimes this can even take years, and therefore it is very important to make his own assessment not dependent on the current share price or become nervous, but practice patience. Because as Benjamin Graham already said, patience is the highest virtue of the investor. Hello and welcome to a new video on Money Tree. I'm Do. And I am glad you have tuned in again. Today's video is about a fundamental virtue in value investing. Patience. But now let's continue with the video. A common mistake among investors is that they run after hot news and jumping prices, and start to invest, but the catch is that it does not work that way, and they only pay the price gains of others, because after the price has jumped, the price usually remains constant at the level reached for a while, and the investors who invested in the stock only because of news get cold feet, because the price no longer rises and they start to sell, and usually with losses. Experienced investors on the other hand know that most of the time stocks just bob along and hardly move, and in only very short phases they rise significantly. 80 to 90% of investment gains occur in a very short window of time, namely 2 to 7% of the investment period. Missing these short moments will also leave much of the total return of the stock, so you should hold your stocks to be invested in this short time, otherwise you will always perform significantly worse than the average. Or in the words of Warren Buffett, if you're not willing to hold a stock for 10 years, you shouldn't own it for 10 minutes. On days without price increases, without movements, without anything, you have to have a lot of patience and discipline and endure these dry spells, because the hot days compensate you for this just as much as the performance of the investment that goes along with it, if you take a look at it months later. This strategy is called buy and hold, and it is used by the stock market legend Warren Buffett, and also his partner Charlie Munger advises it, because this strategy is the only one that offers a superior long-term performance. It is a persistent misconception that buy and hold is about holding stocks for better or worse. This is not true. Rather, buy and hold means buying and letting develop. Shares are not sold because their price falls, but the share is held as long as the positive selection criteria on the basis of which it was once bought are still present. These criteria include quality stocks, the economic moat, and positive company prospects. As long as these criteria are still fulfilled, one can and should also ride out temporary price slumps and even add to the stock. If the selection criteria are no longer met, the shares should be sold, even if it means selling at a loss. For this reason, the concept of the margin of safety developed by Benjamin Graham is of central importance. The greater the discount of the share price to the fair value of a share, the lower the risk of suffering a loss with one's investment. The level of the safety margin should be between 30 to 50%. And, of course, the more favorably one has bought a share, the greater the possibility of high price gains. After all, even on the stock market, the profit is in the purchase, not in the sale. If you like the video, please leave a like and a subscription. Until next time. Your Do.